Bitcoin is stuck at 70,000. It looks steady, but hands are changing. Whales are selling, institutions are buying, and capital is shifting. Meanwhile, macro shocks and technical variables are closing in. Today you'll see who's really making the moves in this round. Where is the market headed next? Wednesday, April 1st. Welcome to BitcoinTV's Chinese channel. I'm Dong Dong. Let's start with the top crypto data headlines from the last 24 hours. The Bitcoin market right now is like a tug of war between two forces. The price is stuck near $70,000, unable to go up or down. On one side, whales are active. The exchange-whale ratio has been consistently high, showing frequent moves by big money and some short-term selling pressure. But the other side is interesting too. Corporate funds are quietly buying. Public companies bought about 62,000 Bitcoin in Q1. Firms like MicroStrategy keep raising funds to buy more. This isn't short-term money, it's for long-term allocation. Looking at ETFs, there are both inflows and outflows. No clear unified direction has formed yet. So the market isn't weak, it's restructuring. Short-term traders are gambling while long-term investors are taking over. The real control is slowly shifting hands. On-chain data has been quite interesting lately. Bitcoin flows suddenly reversed on March 26th. After continuous withdrawals, funds are now flowing back into exchanges. First it was 1693 BTC, then 213, 885, and 1319. It kept climbing, hitting 3615 BTC on March 30th. The pace is clearly accelerating, but remember, over 23,000 BTC flowed out just before that. Basically, they pulled out and are now coming back to test the waters. A key point here is that moving to an exchange doesn't always mean selling. It could be for collateral, leverage, or rebalancing. So the most important thing isn't this inflow itself, but what happens next. If it continues for a few days, it's likely a new strategic move. If it stops or reverses, it's just short-term money testing the market. For the stablecoin USDT, there's an indicator called the flight signal. It shows whether money is rushing into the market or pulling out. A value of 1 means people are hiding in dollars, while 0 suggests money is flowing back into crypto. But here's the catch. The on-chain data tells a different story. On the Tron network, about 177 million USDT left exchanges. It wasn't used to buy coins, but was moved to private wallets. It's like pulling out to wait and see. Plus, order book depth is thinning, meaning the market's ability to absorb selling is dropping. So the market isn't strong. It's stable on the surface, but shrinking underneath. Money hasn't left, but it's hesitant to enter. Any minor news could easily amplify volatility right now. Please like and subscribe. We monitor the latest news 24/7. Our channel offers a macro perspective with 15-minute deep dives to help you quickly grasp major changes in the digital asset space and sharpen your insights. Now for the news. The current situation in the Middle East is no longer just a local friction, but is gradually becoming a bellwether for the global market. Trump's statement this time was also very tough. He claimed that Iran's recovery might still take many years. The signal sent is already very clear. This matter is difficult to settle quickly in the short term, but what the market really fears is not the event itself, but things spiraling out of control. Once it spreads from geopolitical issues to energy, technology, or even the financial system, the direction of capital will change. The crypto market won't be able to escape either, and will eventually be pulled into the overall macro rhythm.
After the US sent a tough signal, Iran responded quickly, affecting 18 tech and financial institutions, including Nvidia, Apple, and Meta. Risks have spread from the geopolitical level to technology and infrastructure. Nvidia dominates AI chips, Apple has over 2 billion devices, and Meta has nearly 4 billion users. Once affected, the impact will extend to computing power, data, and network systems.
They have no Navy, they have no Air Force, they have no anti-aircraft equipment. It's all been blown up. They have no radar, they have no telecommunications, and they have no leadership. It's all gone.
Two pieces of news pulled the market. A softening signal led Bitcoin to rebound to about $67,000 before sentiment weakened and it pulled back. Goldman Sachs noted that if key energy corridors are affected, oil prices could rise and push up inflation. As of 12 noon today, Bitcoin fluctuated between $66,000 and $68,000. Open interest fell, and leveraged funds are de-risking.
The key now isn't watching the ups and downs, but whether you can see clearly where the money is running. Anyone can see short-term fluctuations, but what really sets you apart is whether you understand the flow of capital.
The impact caused gold and silver to lose a combined market value of about $2 trillion in roughly 3 hours. Spot gold's single-day drop exceeded 3%.
But these assets have limitations, namely that they can't flow across borders or be used for settlement. The more complex the situation, the more critical it is where the money goes next, which also determines where the real market trend lies. The future market isn't just one sector running, but the entire macro landscape is reshuffling. Gold and silver rise on panic, while Bitcoin rises on consensus. These two paths don't conflict, but their destinations will be completely different. Friends, let me ask you something. If one day a super powerful computing force emerged that could crack your Bitcoin wallet in minutes, what would you do? It sounds a bit like a sci-fi movie, but this is already being seriously discussed within the industry. Many people feel this is still far off, but once technology accelerates, it won't give you a heads up or wait for you. Interestingly, as early as 2010, Satoshi Nakamoto anticipated this. He left a comment that has now been unearthed, and it could very well be the key to solving this in the future.
Recently, a historical record from the 2010 Bitcoin Talk forum was exposed. Satoshi Nakamoto mentioned then that if potential threats gradually emerge, Bitcoin can respond by upgrading its cryptographic algorithms. That same week, Google's quantum team published research claiming the scale needed for cracking is 20 times smaller than previously estimated, with theoretical calculation times nearing the minute level. This development has sparked market attention. Transactions signed with a post-quantum signature scheme that are broadcast on Liquid mainnet. So it states that the transactions represent the first use of post-quantum signatures on a Bitcoin sidechain. The cryptographic lock Bitcoin currently uses is called ECDSA, which ordinary computers can never crack, but quantum computers can test all password combinations simultaneously, theoretically allowing them to reverse engineer private keys. The highest risk lies with early addresses, where public keys are directly exposed on the chain. Once quantum computing power is sufficient, they could theoretically be cracked. In response, Blockstream founder Adam Back proposed the BIP 360 solution, which uses a software upgrade to switch to a new algorithm that quantum computers cannot crack. Alex Thorne, head of research at Galaxy Digital, stated that while near-term risks are manageable, preparation must begin now.
Let's start with the conclusion. Bitcoin is safe for now, but the countdown for this window of security has begun. Within the industry, it's generally felt that the next few years will be the critical period. Well, Dong is being blunt again. We have to prepare in advance. The good news is that this thing can be upgraded, the locks can be changed, and people have already figured out the direction. The tricky part is that Bitcoin can't be changed just because someone says so. Miners have to agree, developers have to change the code, and wallets all have to follow suit. This is a massive global coordination project, like changing all the locks in an entire apartment building at once without disrupting the daily lives of any of the residents, so there's no need to panic just yet. But two things must be done right. First, keep your assets in mainstream wallets, and second, keep a close eye on the progress of the upgrade plans. This won't happen overnight, but it will certainly draw closer step by step. AI is starting to have problems, and it's not just technical, it's a security issue. With source code leaks, the risk points directly to your accounts and permissions. On the other hand, with $40 billion poured in, the battle for the entry point has fully begun. Welcome back. Yesterday, the tech world was in an absolute uproar. At Anthropic, a competitor to OpenAI, an engineer's slip of the hand exposed the company's entire foundation. So, what happened? Let's talk about the main player first. Anthropic is a top US AI company that created Claude, the AI assistant that competes directly with ChatGPT and is used by many for coding and analysis. It's also the AI model Dong has loved using for years of video making. Even though it's from an OpenAI rival, its Chinese language capabilities are exceptionally strong. Its valuation also exceeds $60 billion, making it one of the top players in the entire AI industry. That's where it stands in terms of status.
Last night, while updating Claude code, Anthropic had a major slip-up. 510,000 lines of source code were dumped onto a public platform, exposing everything core, which competitors can now dismantle at their leisure. This is already their second incident within a week, following the leak of 3,000 internal documents just last week. What's absurd is that on the same day, Anthropic's CEO was in Australia, signing an AI safety agreement, and also happened to drop $3 million Australian dollars on medical research. Talking about safety while crashing, the timing is just too coincidental.
I think it is an experiment, and one way to think about Anthropic is that it's a little bit trying to put bumpers or guardrails on that experiment.
Many people now use AI agents to automate on-chain operations, check markets, send trade orders, and manage wallets, all of which are tied to your API key. Once hackers find a calling vulnerability through leaked source code, the most direct attack targets are these keys. If API keys for Binance or HKEX exchanges are stolen, account assets can be cleared in seconds, and on-chain transactions are irreversible. Check 3 things. Is your AI tool tied to an exchange API? Is the withdrawal permission enabled? And is there an IP whitelist set up?
But today, Dongdong doesn't want to talk about how embarrassing this company is. What I want to tell you is that if you're using AI tools to manage money, watch markets, or execute trades, this could directly affect your wallet. Now, to the point, I support using AI agents for crypto trading. The direction is right, and the efficiency is indeed high. But this incident is a real reminder. Giving your API key to an AI tool is like giving your house keys to a restaurant whose kitchen you've never seen. This time, Anthropic wasn't hacked. It was their own slip-up. Next time, it might not be just a slip-up. Protecting ourselves is simple. Give AI tools read-only access, never withdrawal permissions, change API keys regularly, and enable IP whitelists on exchanges. Remember one thing, let AI help you make money, but don't give it the chance to help others spend your money. When Dongdong installed Lobster, it signed me up for a membership on its own and cost me $30. What pitfalls have you encountered with this? Have you checked your own settings? Feel free to share in the comments. You think this is just fundraising, but it's actually a race for position. OpenAI secured tens of billions not because it's already profitable, but because it can't afford to fall behind. This AI competition is no longer just about technology. It's about who can seize the entry point faster.
SoftBank led an investment of about $40 billion, pushing OpenAI's valuation to $300 billion. This scale is no longer ordinary investment. It's top-tier capital securing its position in advance. The logic of phased investment is clear. Whoever can maintain the lead gets more capital. This money isn't an investment in the present. It's buying a seat in the future. 30 billion later, but also maybe not 30 billion later, depends on whether this company OpenAI can restructure.
More importantly, OpenAI's current logic is counterintuitive. It proves its value through expansion, not profit. At this stage, whoever runs faster is more likely to become the next generation of infrastructure.
Data shows OpenAI has entered a rapid expansion phase, with revenue expected to rise from about $3.7 billion last year to $12.7 billion this year, with room for more growth. But with costs for training, computing, data centers, and talent rising, short-term profit isn't the focus. Funds are mainly for expanding capability and scale.
Capital today isn't looking at who makes the most money, but who can secure their position. This competition is no longer about product versus product, but a head-on clash of resources. Computing power, talent, and model capabilities are all in the fight. As these assets concentrate in the hands of a few giants, the industry gap will widen instantly. And for us users, this isn't some distant concern either. Once AI becomes infrastructure like water or power, how you use tools and access information will be redefined. This $40 billion looks like an investment in one company, but it's a bet on who controls the next-gen gateway.
Stablecoins have reached $150 billion. If they offer interest, money could move from banks to the chain. This isn't innovation, it's a grab for deposits. This is exactly what banks fear the most. US regulators are done testing the waters. Non-compliance means immediate market restrictions. It used to be fines, now they just shut you down. The gateway is being seized by a few players. Over 300 million people use crypto now, but many don't even hold their private keys. If a platform fails, you'll see a balance, but whether you can move it is another story. The money hasn't left, it's just changing places. 23,000 coins flowed out in 4 days, then immediately started flowing back in. This rhythm shows the market is still testing. No one wants to make the first move. Institutions now hold over 3 million bitcoins, about 15% of the total supply. With more ETFs and corporate allocations, Bitcoin is shifting from a volatile asset to a portfolio tool.
Stability might be the most dangerous illusion right now. Many still seek stable jobs, but AI is devouring those very positions first. Jobs with clear processes, high repetition, and standardization are being replaced by machines layer by layer. You think you're holding a position, but you're actually clinging to an obsolete model? True value lies in judgment, not execution, being the one who decides in chaos and owns the results in uncertainty. A company never gives you security. You have to throw yourself into the market. When a job can be clearly mapped as a process, it's only one line of code away from being replaced. All right, that's it for today. Our channel focuses on core narratives and value discovery in the digital asset space. If you find our channel valuable, please share and follow, or you can become a member. For access to higher-level research reports, check out our advanced channel. Monday through Friday, we share deep market cycle reviews to capture certain opportunities within trends. See you tomorrow.